Hi, Kim. Thank you so much for joining us today. We're happy to have you walk us through the buying process in terms of the mortgage side of things. Can you tell us a little bit about yourself?
Yes, thank you so much for having me. I really appreciate the opportunity. My name's Kim Stone, and I'm a licensed mortgage loan officer. I've been doing mortgages now for about 20 years, and I currently work with Radius Financial Group, which is a company based right here in Massachusetts.
Okay. Did you have a slide presentation that you wanted to use as we go along?
I do, actually.
Okay.
Would you like
Let me
me to share that?
Sure. Let me make you host.
Okay, great.
Should be good to go.
Okay, great. Can you see it?
I can.
All right, let me bring it over here so I can see it too. Okay, great.
All right.
Um, so I'm happy to go through the slides, or if you wanted to ask me some questions that you think might be specific, whatever you think works best for you.
Okay. Well, I see that first up on your slides is whether or not you should get a pre-qual or a pre-approval. Can you tell us a little bit about the difference between the two?
Yes, I'd love to. Thank you. So when you start looking for a home, the question that most people are going to have, realtors, you, and a seller, is if you've been pre-approved or pre-qualified to ensure that you can get the financing you might need in order to buy the house. So there's different levels of approval based on the different levels of review. So the application is pretty much the same. The difference comes with the lender or the bank and how they review the application and how much information is documented or gathered for that pre-approval or the pre-qualification.
Okay.
So for pre-qualification, it's going to be more of a verbal confirmation of things like income or your assets. And we do take a look at the credit score to make sure that that credit score is going to qualify. And we'll take a look at the credit report as well. For a pre-approval, we're going to get into quite a bit more depth, and we're going to ask for the same documentation that you would provide to get the actual home loan. So you're going to have a lot more confidence in a full pre-approval since we're looking at the supporting documentation, things like your W-2s, pay stubs, and tax returns, as well as your bank statements, to ensure that those are going to fall within the guidelines so that when you have a pre-approval, you know that that has been reviewed and all your paperwork's been reviewed by the loan officer.
Okay. So does a buyer need to get either of these things before they start looking for a house, or is it not needed?
So generally speaking, when somebody calls a realtor, usually the first thing that realtor is going to do is suggest that they get either pre-qualified or preferably a full pre-approval. So in short, if they're going to start looking and they're going to start working with the realtor will most likely want them to get pre-approved. So yes, there are cases where you can go out to open houses and visit at an open house and not have a pre-approval for that. But when it does come time to make an offer, you're definitely going to want to have a pre-approval in hand.
Can someone make an offer without having that pre-approval?
So that's a great question. It may be more of a question for the realtors, just because they're the ones who actually are putting that offer together. But generally speaking, you're going to want to have the pre-approval in order to present the offer so that you know you're qualified to buy the home, and everybody else who's involved in that transaction knows that you're able to buy the home as well. So I would say yes.
Okay. Now you mentioned credit and pulling the credit and looking at that. Is
Mhm.
that something, I get questions all the time from buyers, is that going to hurt my credit by having a lender look at it?
That's probably the number one question that we get in lending is, are you going to have to pull my credit, and is it going to hurt my credit? I believe I have a slide in here about pulling the credit. But as far as pulling the credit, the short answer is a credit pull for a mortgage application or pre-approval is different than a credit pull for a credit card, a line of credit, or a charge account, or a personal loan. So any inquiry could impact your credit score, but for pre-approval, it's going to be less significant than if you're out applying for credit cards. And the reasoning behind that is that's a financial inquiry to see if you qualify for a loan, a secured loan, an installment loan that's going to be evaluated on more things than just your credit score. The other inquiries are for revolving credit most oftentimes, or unsecured credit. And they really don't go in depth. A lot of people can get that, just the credit pulled at a store and get a store card approved while they're checking out at the cash register. So obviously they're not reviewing as much information. So that type of a credit pull is going to drop the credit score a little bit, because they want to make sure you're not just applying for revolving credit and getting yourself into a situation we have too much revolving credit and it hasn't been reviewed on the ability to repay it. So on a financial inquiry, like a pre-approval, we will pull the credit. If it does impact it, usually within the next 30 days, that's going to rebound. And so any score reduction is going to bounce back a month later. And even if you get a mortgage, you're going to find that mortgage is not going to drop your credit. You've actually been granted a secured line of credit. It's being secured by the home. So a credit pull doesn't actually impact your credit with a mortgage or a pre-approval the same way that a credit card would. And then actually years ago, regulations were put in place so that it's understood you might even shop for a pre-approval to make sure you're getting the best program. And so the first inquiry is the inquiry that counts as far as scores go. And then you can actually have your credit pulled multiple times over the next 2 weeks or so, and those additional inquiries will not drop your score further. That's different than a credit card inquiry. The additional credit pulls for credit card inquiries, every one will impact your credit. But for mortgage, just that initial pull.
So if I want to look at a mortgage broker and a bank and a credit union within a couple weeks, it's okay?
Yes, within a couple of weeks. You don't want to do it over a long period of time. You really want to try to get it down to a couple of weeks. So within the first 2 weeks.
Okay. Did you want to catch up a little bit on your slides? I know I just started throwing questions at you.
We can, sure. Or you can keep asking questions, and if there's slides there, we can turn to them.
Okay. Well, why don't you just run down to get kind of us caught up to where we're at? And if there's anything along the way that you think is worth noting, feel free to jump in.
Okay. So the next slides were really about what goes into the application for a pre-approval, and what's considered as far as what we need to look at and what we have to review in order to make a determination. So any pre-approval or pre-qualification, it's a 2-year look back, both for your residential history and where you work and how much you made. So it's going to be up to 2 years, and that's for all mortgage banks, lenders, and credit unions. It's actually the same application that we've been taking as long as I've been doing mortgages for 20 years, and it's the same look back period. So they're going to ask things like, where did you live? And did you pay rent? Did you pay rent on time? Are you living with family, living free? Or living rent free is what it's called. And then they're going to ask, who did you work for? How much did you make? How much are you making now? If we stopped there, it would be a pre-qualification. If we then go and say, well, let's get your W-2s and your pay stubs, then that's going to move it into a pre-approval. And that's going to be noted on your pre-approval letter when the decision's been made.
Okay.
The other thing that they're going to look at will come up next, is the 4 C's of your application. So character, collateral, credit, and capacity. And when underwriting and your loan officer looks at this, they're taking the whole picture of your application and seeing if these 4 things can be met to make a determination on that pre-approval. So character, that's evaluated by your actual credit history. So a lot of times I get a call and somebody says, well, my credit score is XYZ. Can I get a loan? And that credit score tells us whether or not we can get out of the gate and start the process. And then the rest of that credit report is going to give us the character. And so that credit report comes with address variations on it and all the credit you might have had over time and your payment history on them and the types of credit that you've gotten. And they even can come out with employment history and address variations as well. So we look at the whole credit report. Collateral, that's the value of the property. That's when you actually find the home. We're going to get a bank appraisal. Credit, and this is what I just touched on a little bit. Do we have a qualifying credit score to get out of the gate? And the other thing we might touch on if there's time is how that credit score will determine which way we might go with your loan program. There are several loan programs out there available today, and a good loan officer is going to take the time to make sure that you're getting into the best financial situation and the best loan program. Sometimes the best rate doesn't necessarily dictate the best payment. And at the end of the day, the payment is what you're making every month. So you want to make sure that that's really going to be the lowest or the most attainable for you. And then the last one, and this is the most important rule when doing pre-approval, and that's the capacity. A regulation was put in place years ago called the ability to repay. And it's the #1 guideline that underwriters are going to underwrite to. And that means based on what we have with your financial snapshot today at the time of your application, do you have enough income to pay what we see on your credit report already, as well as a new mortgage?
Okay.
Now,
How
and
much?
that pretty much gets you. Go ahead. I'm sorry.
No, go ahead. I didn't want to cut you off.
No, that was pretty much it.
Okay. So how much do you need to buy? How much money?
That's a great question. And it actually brings me right to the next slide. So when you buy a home, there are a variety of things that you'll need actual money in your bank account for. You may want to have a home inspection. I'm sure you're going to go over that in the class. You may want to have other inspections as well, water. Well, those are the biggies, right? A home inspection, and then depending on the property, maybe some other things. Water, pest, a VA loan requires pest. And then the next is how much will you need for your down payment? And we'll probably get into closing costs as well. So I put together a little chart of the minimum down payment requirements for the majority of the programs that we see in this area. There were some 100% financing programs out there. There are still 2 100% financing programs available that you could qualify for. But generally speaking, the rule of thumb is to have anywhere from 3 to 5% down in order to buy a home.
Okay. So this slide, I don't know if you're seeing a change in the slides, but the slide that I'm looking at still says pre-qualification or pre-approval. So I'm not sure if they're advancing.
Oh. Let me see here. How about now?
Yeah, it's working now.
Great. So here's the slide that goes with the 2-year look back that we just talked about.
Okay. This makes much more sense now.
Oh, great. Sorry about that.
That's okay.
There's the 4 C's.
Mm-hmm.
And here we are on down payment.
Okay, so this is the chart that you were mentioning.
Mm-hmm. I'm glad we caught that. Thank you for letting me know. Yeah, so there are, Mass Housing does still have a 100% financing program. But with the current climate, they've put some of their 100% financing programs on hold. So that also is something that your loan officer will look at when your application comes in. Sometimes, clients do have the money for a down payment, but they may not necessarily want to use it. And so we can look at a 100% financing program. But traditionally, these are the programs that were available up until that mass housing program became available just last year. So generally speaking, you'd want to have 3 to 5% down of your purchase price in order to buy. So the next slide that I put together kind of shows you the math for that. You would basically just take your purchase price, and most phones have, a little calculator on it. You just take your purchase price and you multiply it times whatever your down payment is for your program. So 3% down if you're doing a conventional first-time home buyer program. And you just hit 3% times 3%, and that's going to give you the number that you need for your down payment.
Okay.
Go ahead.
So in the past, people have said, well, don't I need 20% down to get a conventional loan? Is that not the case?
That's a great question. And actually, I've heard today that there's a lot of misinformation still out there on the internet, and people still believe you need 20% in order to buy a home. And no, that's not true. It was really around the 80s, this started gaining some traction, and that's when PMI came into play. So PMI is private mortgage insurance, and what it allows us to do is write a loan above 80% of the value, meaning you'd need less than 20% down in order to buy the home. And so you can do programs like a conventional program with only 3% down. So what happens is you put 3% down, and along with your mortgage payment is a payment called PMI, and that's for conventional. With FHA, it's actually called MIP. So it gets confused a little bit because it's the same letters, just in a different order. But they accomplish very similar things. They allow you to have a very low down payment and not have to come up with 20% out of pocket, because that's a significant difference.
Okay.
And that payment should get told to you when you're going through your payment with your loan officer. The payment, including the mortgage and the PMI, should be explained so that you know exactly what's going into that monthly payment and whether or not it's in your budget.
Okay. And also on this slide, it talks about closing costs. So how much is closing costs gonna run?
That's a great question as well. So closing costs, the old adage is you should figure on about 3% of your sales price for your closing cost. That pretty much holds true with a couple of exceptions. If your loan amount, if your purchase price goes towards the 150 and down, well, 3% of 150 is not going to add up to a lot of money. And so at that point, you may need a little bit, they may be a little bit more. And the same is true when you start getting to some of those higher purchase prices as well. Then 3% of those numbers is much higher, and it may not actually be that high. So generally speaking, you want to figure around 3%, and you can see with the conventional loan that you are actually allowed up to a 3% closing cost credit with 3% down. FHA actually allows for up to 6%, but you almost never need that much to cover your closing costs. If you do, there's usually an extenuating circumstance.
And what's involved in closing costs? What are you paying for?
Let me see if I have a slide for that. I do. So when it comes to closing costs, it really breaks down. Some people will say 4 buckets. I like to say it's really 5 buckets or 5 boxes that go into your closing costs. And I tried to break them down for you in some straightforward, a straightforward outline here. So you have the lender, the attorney, you have your government recording, and then your escrow, And then you have a fifth box, which is kind of final inspections, kind of balance the house out. You know, you take over the house the day of closing, and the seller's responsible for the house up to the day of closing. And that's the box that some people don't really include lenders, because we don't really see that part of it, but it does happen at closing. So I always like to go over it. So break them down basically. The first is the lender. So what does the lender do? Well, the lender is going to help you get that mortgage. They're going to write a loan so that you can buy that house and pay them back over a long period of time, and you get to live there the whole time. They have to process that file. A processor, she's like your admin on the file. She gets the paperwork from all over the place. She's objective. She has no skin in the game, as they say. So her job is to objectively gather paperwork from everywhere we have to get it. So the appraisal has to come in, the title attorney has to send her stuff. We have to verify employment, things like that. She gathers all of that. There's the underwriter. That's the person who's going to look at all that paperwork and determine whether or not it meets the guidelines. The loan officer. So that's the person who structures the loan, gathers all the initial paperwork, finds the best program for you. And they're also the person that monitors that file from A to Z. They stay with you from the time they take that application all the way through to closing, and make sure that that process goes smoothly and everybody's on track, along with your realtor, of course. And then there's some third-party items that we need. So the appraisal is one. We want to verify that. The credit report does actually cost us money. So we actually pay for credit reports all the time, even on loans that don't go anywhere. And then, of course, the town has to certify that the taxes are all current and that you're not in a flood zone. So that's the lender side of it.
Okay.
Go ahead.
No, I was just saying, okay. So then what else?
So the next section would be the attorney, also a very valuable member of our team. The attorney, when you buy a house, there's a lot of paperwork, and it's all legal documents. And at the end of the day, it's always what's in writing. And that's where the attorney comes in. So the attorney is going to review that purchase and sales. They're going to make sure the protections are in place for you, the buyer, that the dates make sense. And they also will monitor the transaction throughout to make sure that we're on time. And the seller's side is also doing what they need to. On the buyer's side, you've got your realtor and your attorney. And on the seller's side, they have their realtor and oftentimes an attorney as well. And those parties are going to talk to each other to make sure everything is happening and staying on track. On occasion, something might come up. It might be a home inspection issue. It might be something that's on title. It might be a property line. It might be something that was recorded earlier. And those parties are going to have to talk about it and work through it. And that the attorney is going to do all of that along with your team of realtors and oftentimes your loan officer as well. And then they sit with you at closing as well. And they go through all that paperwork and make sure everything is signed. And then they take that paperwork to the registry electronically now, and they record that says you now own this home, that you are the proud new owner. And so that's what the attorney does for you.
And what about escrows?
So that's a bucket that I get the most questions about. These are not charges from the lender or the attorneys. So the escrow bucket is not actually a fee. When you buy a house, the seller pays for things like property taxes and their home insurance right up till the day of closing. When you take over the home, that becomes yours going forward. Well, when you buy a home, if you use a low down payment program, the lender's going to want to set up an account. An escrow is an account that's held for a specific purpose, and they're going to put some money in that account so that when the next property bill comes due, there's enough money in that account to pay for that property tax bill. And the same thing with your homeowner's insurance. So when you buy a home and you close on that home, you're not going to make a mortgage payment that month because you've just closed. So there's nothing due. The loan just became active the day of closing. And then the next month, you're actually going to skip that month as well. So no payment's going to be made that month either. The first month is the month after that we collect, the lender or the mortgage company will collect your very first payment. Now, oftentimes, especially in Massachusetts, taxes are due quarterly. So chances are a tax bill is going to come due before we've collected enough in your mortgage payment to pay that. So what do? We set up an escrow account and we collect those payments at closing so that the buffer is already there and that money is already in the account. You get to skip those next 2 payments, and when the bill comes due, we now have had enough money in to pay that bill. And the same thing with homeowners insurance. That usually gets paid up front, but then of course we're going to collect enough so that next year when that bill comes due, we have 12 months of payments in the account to pay it. And that's what an escrow account does.
Okay.
And all of that actually goes right to record, your mortgage, your note, and your deed. In several towns all over Massachusetts, there's places called the Registry of Deeds. You can Google that, and their fees are right online. And whatever they are is exactly what they are on your closing disclosure as well. And that's so everything gets to record. And if you ever go into the Registry of Deeds, you'll find big old leather tomes dating back to the beginning of property sales.
And you mentioned final property bills or inspections. What's that all about?
So this is something that sometimes doesn't get covered, but I like to make sure people are prepared for it. Just like the taxes or the homeowner's insurance, when you buy a home, there may be a water bill or a utility bill. You know, you're going to take over those. There might be oil or pellets in the basement. These are all things that you need for that house to be livable, right? Functional. Water, heat, electricity. So those bills also get prorated right to the day of closing, and the seller's responsible right up to that day, and then you'll take over that going forward. But those bills don't work on real estate schedules. They work on their own schedules. So sometimes those need to be prorated. And so when those are prorated, it gets settled right at closing. And those are things that we don't see as a bank or lender because they're associated more with the house, not the financing of the house. And so we don't see those, but you always want to be prepared for that and have some extra funds set aside so that if those, bags of pellets end up being left for you, the seller may need to be compensated for the bags of pellets or the oil that might be in that tank or the propane that might be in that tank. Or the electric or gas might be on a system that's a budget plan is what it used to be called. So that also would be prorated, where you would then take over that budget plan mid-month or whenever you close, and the seller is responsible up to that day.
So when you're buying, you mentioned most of this stuff happens at the end when you close, that you pay for these things. Is there anything along the way that you have to pay up front?
So that's a great question. So for the lender part of it, let me see if I have a slide here. I don't think I have a slide for that one. Oh, there's the slide for the escrows. So it looks like I do. So as far as other items that you might need up front, when you first go into an offer, your realtor's going to ask you for a copy of a check. It's almost like a deposit. And I'm sure you'll get into that as well as far as what you might pay at the time of an offer or purchase and sales. And chances are you're going to want to have a home inspection. So those would be funds that you'd also want to have on top of what you need for your down payment or closing costs to cover those. As a lender, the only thing we really collect up front are going to be things for the appraisal, which is an actual person who goes out and does that. And there are some first-time homebuyer classes that still have a fee associated with it. So those would come up. Other than that, other than your inspections as well, there's not usually anything else that comes up out of pocket prior to closing.
You had touched on that sometimes you can have a seller pay closing costs.
Mm-hmm.
How does that, can they still do that in this market, or how does that work?
So it is happening in this market, and in the Central Mass, North Central Mass area, I'd have to say it's almost common practice. A lot of times at the end of the day, the seller has a number that they need to walk away with or what they'd like to get for their home. once that number can be established, you may be able to go over that and ask for the seller to contribute towards those closing costs. So, and the programs allow for it as well. So on a conventional loan, you can get up to 3% back if you're using a minimum down payment. If you're putting more down, you can actually get up to 6 and 9% back from the seller. And with FHA, you can get up to 6% back. With a closing cost credit, any credit they give you has to go towards closing costs. And so that's a little bit of a balancing act. And usually the realtors and I will have a conversation about how much is needed to cover the closing costs for that specific file, because we want to make sure it's enough to cover what you need, but not so much that there's too much there and it ends up being called left on the table. And what that means is there's too much of a credit there and we can't apply it to the closing costs. So it actually goes back to the seller. And so it is a little bit of a balancing act. We try to get it as close as possible so that everybody's happy. So when you ask for closing costs, and this is a conversation you might have with your realtor, you might have an agreed upon sales price, but know that you need the closing costs back. So you may go over that to get the closing costs back. So for example, let's say you had a home that was going to sell for $200,000 and you knew you needed $5,000 to help you with closing costs. You might offer $205,000 with $5,000 back so that the seller is still getting the $200,000 that they need and you're getting the $5,000 you need to help you with those costs.
So generally the seller is going to be looking at what they're going to get net.
Generally speaking, for them, it's what they're going to net. Yes.
Okay.
And you might have a perspective on that too, I'm sure.
I do. All right. Is there anything else that you wanted to share that we touched upon but didn't really cover that you think is important to talk about?
Yeah, we touched a little bit on payment and what goes into a payment. So it might be a good idea just to go over what goes into a typical mortgage payment. If we have time for that. So when you make a mortgage payment, when you pay rent, you pay one number usually, and it covers you for the month going forward. When you make a mortgage payment, you have principal and interest. That's the actual mortgage payment. So when you write the mortgage, you borrow a certain amount of money, and then you pay us back with interest. And that's why everybody wants a low rate, because the lower the rate, the lower amount of interest you have to pay back, which also translates to a lower payment. And then you have your property taxes and your home insurance, and then the PMI. So I put a little chart together for you so that you could see. Now, the rates on here are obviously not the rates of today, so don't let the rates scare you. It's more about the payments than the rates on this page, because the rates I would say are considerably higher than the rates that we see today. So don't let that scare you or anything. So when you look at each of these loans and you look at the bottom, the last line where the boxes are, and you see the total monthly housing payment, that's actually including everything from the mortgage itself, the taxes, the insurance, and then the PMI or the MIP that might be associated with that home. And this is where having, the right loan officer go through all these programs for you to make sure that you're getting in the best payment. So for example, if you look at column F, which is the mass housing program, that payment is actually one of the lowest payments, but it actually has one of the higher rates on the page. With a 5.25% interest rate, which again, much higher than the rates are today, but you can see it didn't translate to a higher payment because the MI associated with that loan is so low.
Okay, so you have to look at more than just the rate. It's all the factors that go into the loan product that you're gonna get.
Yep, absolutely.
Okay.
Yep. And the same thing if you look at A versus B. A is a first time or a home buyer program, and B is a traditional conventional loan. you would think with a rate difference that high, it would be a fairly significant difference in the payment, but it's really only a $40 payment, and you're talking about almost 0.75% in the interest rate. So, yep, so you'd want to make sure you're talking about the best program for you, which brings in the best payment for you.
Okay. All right.
Mhm.
Well, thank you so much, Kim. We really appreciate you joining us. And one question that I've been asking everyone is, do you have any words of advice to someone starting the home buying process and what they should be thinking about or concerned with? Or what do you think?
I would say the best thing would be definitely get pre-approved, um, and make sure that the person you're working with is asking for things like your pay stubs, W-2s, and bank statements to know that you are definitely getting pre-approved. Also, ask questions. Never be afraid to ask any questions at all. An educated home buyer is the best home buyer to be, because you want to get in that home and you want to be able to stay in that home. And then, of course, surround yourself with a great team of professionals to get you there. Loan officer, realtor, and attorneys, having the right people in your corner can really make that transaction happen for you.
Okay. Thanks again, Kim. We really do appreciate you taking the time.
Oh, it's my pleasure. Thank you so much for the opportunity. I hope everybody enjoys the class and gets something out of it.